Very good morning to everyone. Like what we discussed in the previous class about based on asset class, I have started with the equity fund and I have explained about large capital, mid capital, small capital, sectoral fund, thematic funds, and I have explained about debt funds, short term, long term, liquid, gilt funds. Coming to the hybrid funds. So here we are going to study about the hybrid funds, how these hybrid funds or the schemes which will be helpful for the investor to invest and how these investments are made in what context. So hybrid schemes also explain about mix of equity and debt, balance, risk and return. So hybrid is a combination of equity and debt. So it will investing in the mix of equity and debt, balance, risk and return. An example, aggressive hybrid, conservative hybrid in the balance fund you have. Let us discuss with the first, other than the aggressive, we have a lot of other funds too, but let me just go for starting with the funds of hybrid schemes, where first one I will take as a conservative hybrid fund. A conservative hybrid fund is also called as an open-ended hybrid fund or scheme investing predominantly in the debt instruments. So conservative hybrid fund is open-ended fund. And open-ended fund, I already said that it's a you just buy today and you sell. It's an open to do transaction at any time to everyone. You can buy and you can sell at any time. There is no fixed maturity period initially. So open-ended fund, open-ended hybrid scheme investing predominantly in debt instruments. Investment in debt instruments shall be between 75% to 90% of total assets, while investment in equity and equity instruments will be 10 to 25%. So a conservative hybrid fund is an open-ended hybrid scheme investing predominantly debt instruments. So debt instruments in form of 10 to 25% of equity and of the total assets, and when it's come for debt instruments 75 to 90. So it also talks about how investments are made under debt instruments. And coming to the second one on hybrid, we have studied about the balanced hybrid, or which is called aggressive or balanced fund, balanced or aggressive hybrid fund. But we'll study about both different perspective, what is all about hybrid balanced fund. A open-ended balance scheme investing in equity and debt instruments. So a balance hybrid, again, it is balancing between debt and equity. What is the proportion of debt and how much is the equity? When I said that proportionate of 40 to 60 out of 100%, how much should be debt and how much should be equity instruments? So it might be the 60 of equity, 40 of debt. So balance is between debt and equity. So it is called open-ended balance scheme investing in an equity and debt instrument. So investment in equity and equity related instruments shall be 40% and 60% of total asset, while investment in debt instruments. So I said very clearly, a hybrid is a combination. You had open-ended, close-ended, but hybrid talks about open-ended, close-ended, but at the same time investment in both the instrument, where you have a equity instruments, you have a debt instruments, but the proportionate might be 60% of equity, 40% of debt, vice versa it goes on. So no arbitrage is permitted in the scheme. Okay, so it is very much systematically very clear how investment is done. So you will get an idea about when you go forward in market through the investor, how they invest in a hybrid or balanced aggressive hybrid funds. So when it comes to aggressive hybrid fund, here an open-ended hybrid scheme investing predominantly in equity and equity related instruments. Aggressive talks about invest in equity instruments. Investment in equity related instruments shall be between 65% and 80% of total assets. So it is very clear that if it is a debt instrument, shall be between 20 to 35%. So if you're investing in the market, the instrument might be the debt and equity. So if you're investing in debt funds will yield a fixed income. You can see the same slide here, the second point where it is written invest in fixed income instruments like bond, government security, corporate debt, many other. It might be short term, long term, liquid or gilt funds. So when it's come for debt fund, it will yield one fixed rate of return on certain maturity. But when it's come for equity, you invest especially primarily as a stock. Stock has a primarily objective to invest, where there is no guarantee that you might have a percentage in your mind that will yield this much percentage of, or 60 to 80% will yield in form of stocks as a return. But sometimes if market is profitable, then only you can expect. If market is under loss, may lose your investment. So it's very clear when it's come for hybrid fund, it's a combination of aggressive, conservative, and the balance. When it's come for conservative, I said it's a combination between both debt instrument and equity, hybrid also debt and equity, but percentage will vary. Percentage will vary. So here, an open-ended hybrid scheme investing predominantly, I said, aggressive to be between 65 to 80%, and when it's come for debt instrument, 20 to 35% of the assets. So mutual funds in India are permitted to offer either aggressive hybrid fund or balanced fund. And coming to the same hybrid fund, you have a dynamic asset allocation balance advantage. Like it is an open-ended dynamic asset allocation fund with the investment equity debt that is managed dynamically. There is a multi-asset allocation also, an open-ended scheme investing in the least 3 asset classes with the minimum allocation of less 10% of each in the 3 asset classes. Foreign security are not treated as a separate asset here, right? Then you have an arbitrage fund where open-ended scheme investing in arbitrage opportunities. Minimum investment in equity and equity related instruments shall be 65%. So then you have a equity savings. You have a equity saving. When it's come for equity savings, you have a open-ended scheme investing in equity, arbitrage, or debt. Minimum investment equity related instrument like 65% of the total assets, and debt shall be 10% of total assets. So minimum hedged, unhedged investment need to be stated. Okay, so this is all about the equity savings. So what is all about this percentage? That is nothing but the ratios. The ratio between the debt and equity. How much in form of equity, how much in the debt instruments as a total assets. Then you have some kind of a money market funds here. I already said about money market funds, about invest in the short-term debt like treasury bills, certificates of deposits, and commercial paper. Certificates of deposit through bank, commercial paper, and treasury bills, right? There are many people investing in form of a short-term debt instruments. They are the debt instruments. Why? Because you need to repay along with the rate of interest. Then coming to the commodity funds. So here, when it's come for commodity fund, invest in commodity like gold, silver, and other type of securities. Commodity, example, gold exchange traded funds, ETFs, gold exchange traded funds. Then you have a the next slide talks about based on the investment objectives. Based on the investment objective, here you might be seeing about growth fund, income fund, index fund, tax saving funds. Tax saving fund. So here you should know what is all about the tax saving fund, growth fund, income fund, and with the index funds. So under growth fund, you might be seeing here aim of capital appreciation. Growth itself is an aim of capital appreciation. So I have already said about in the before also, the growth always talks about appreciation of your investment in the long run, and people just invest these funds by waiting period of somewhat years, might be more than 1 years. Then how this capital appreciation might take with the total investment whatever it has been done. Then you have a income funds, focus on providing regular income through investment in bonds and dividend paying stocks, so which is called dividend yield fund. So open-ended equity schemes investing in the dividend yielding stocks which will give you a fixed dividend or component of various dividend classified based on the investment. So you have a Some people call it corporate bond funds, were rated under investing under A plus plus above rated corporate funds. Like that, income will yielded or regularly fixed income investment bonds and dividend paying stocks. Index funds always tracking on the what Nifty, NSE, right? Uh, Stock exchange, then track kind of a replicate the performance of specified market index like S&P 50, 500, right? Top most 50 company, 500 fortune companies, right? And all these are classified index funds, investing in the index funds. Then you have a tax saving funds, which is called equity linked saving schemes that tax benefits under specific laws. And I already explained about ELSS as an open-ended equity linked saving scheme, which is a statutory login period of 3 years and tax benefit, and it is related instrument shall be 80% of total assets. So equity linked schemes 2005 notified by Ministry of Finance. So under section 80C in India. So they are equity linked savings scheme and offer the tax benefit. Many people invest this kind of a based investment objectives. Then you have a based on the management style, which is also called actively management funds, passively management funds, and there are different types of actively, passively, low risk funds, medium risk funds, and high risk funds. So about index funds, I said how open-ended tracking specific index, minimum investment in security particular index, right? Then overseas or domestic fund underlying the fund when it's come for 90% of the total assets. Then you have a here when it's come for oriented schemes like retirement fund, open-ended retirement solution like 5 years or till retirement age. Children fund, you have a children having a lock-in for the least 5 years till they attain the age of majority, right? So when you have a actively managed funds managed by fund manager who actively buy sell asset to outperform the market, which is called active or actively fund managed. Now when it comes to actively managed fund, there is called passively managed fund. But when we go for actively managed fund manager has flexibility to choose the investment portfolio, especially this kind of funds where the fund manager has the flexibility to choose the investment portfolio within the broad parameter of the investment objective of the scheme. Since this increases the role of fund manager, the expense for running the fund turn out the higher. Investor expect actively managed fund to perform better than the market. So actively managed funds are funds which are fund manager flexible to choose the investment portfolio within the parameter of investment objective scheme. Then we talks about passive funds where investor or invest on the basis of specified index, passive, whose performance it seeks to track, like passive fund tracking BSE Sensex would buy only the shares that are part of a composition of the BSE Sensex. The proportion of each share in the scheme portfolio would be same as the weightage assigned to the share of BSE Sensex. So performance of these funds tend to mirror to the concerned index. So I'll tell you the passive funds are basically specified index. So actively there are difference between active and the passive. Passive aim to replicate performance of market index with the minimum trading. Okay, so active managed funds and passive managed funds. Then you have a based on the risk profile. There are fund based on low risk funds like include liquid funds, money market funds, short-term funds. Where in low risk funds, people who are ready to invest there also, where there is low risk and expect some kind of return. There is a medium risk funds, include hybrid funds and income funds, which will generate the income. High risk fund include equity fund and sectoral funds. Then you have a specialized fund, which is also called a sectoral thematic funds, which focus on specific industry or themes like technology, healthcare, or infrastructure. Then you have a International global funds invest in foreign market to global company. It's all are also called as in the specialized funds, where people should know that we focus on what type of technology, healthcare, and thematic and sectoralized side, investing in infrastructure or companies like steel, cement, or many other. Thematic also talks about technology, healthcare, infrastructure. Then focus fund investing in limited number of stock, focusing quality over quantity, right, which will yield more return rather than buying which is not doing good. Then uh, you have fund of funds, FOF, invest in other mutual fund instead of direct stock or bonds. Then ESG funds, investment in company that meet environmental, social and governance criteria. So there are today, when we talks about ESG funds, investment company meet environmental. I can give you example, solar energy projects, or electrical vehicle projects, or hydro projects, ethanol projects, right? There are so many company which are meeting the environmental issues of the concern, and these funds especially can go for defense funds, right, manufacturing defense. So here there are a lot of funds where it will grow, if not now, in the later coming years, with the specific objective. Now coming to all those things what we have seen before, uh, there are some questions like how to choose. So how to choose such kind of funds? So your choice of mutual fund depends on the factors like, normally everyone knows about the choice of choosing the financial goal should be matching with the objective of an individual and the company. Like I have explained so many examples about different types, different schemes, different classification of schemes, and different types of funds, with the example investment with the total assets of what percentage. And that's why I said that there is a minimum investment in equity or debt related instruments, where it might be percentage, it might be vary from total assets like 40/60, 75/25, 70/30. It depends with the risk and return preferences. So here choice of mutual fund depends on the factors like financial goal. One should know about his financial goal, risk tolerance, how long I can wait, about risk of the company, investment horizon, tax planning scheme. So normally, as a common person who would like to invest in any kind of stocks, bonds, or liquid assets, or any kind of a convertible assets, here it can be any types of stocks or mutual funds. Here the main purpose of investment will be meeting with the financial goal, risk tolerance, investment horizon, how long my money can be safe and diversified, get return, and the tax planning. One of the objective today with the investor investing under tax saving, tax planning, or meeting expenditure by converting that expenses as in tax money. So all these are very clearly classified, and people just will choose in different perspective. So I have covered the classification of funds, starting from structure, open-ended, close-ended, interval funds. Then I have said about actively managed funds, passive managed funds. Then I said about multi-cap, mid-cap, small cap, dividend yield fund, large sectoral thematic, overnight funds within one day, can be overnight, corporate fund which has rated in the market. Then I said about credit risk funds. The company has a highly rated corporate bond, right? And you can go for investing in such kind of a bonds. Then the banking and PSU funds, public sector undertaking, PSU funds, instrumental banks, where it will yield one fixed rate of return. Gilt, I said, gilt is nothing but one of the open-ended debt, investing in the government security. Gilt is in government security across a maturity. Minimum investment in government security is defined as 80% of total assets. Then the gilt fund with 10-year constant duration also is said. Like you investing in the government security having a constant maturity of 10 years. There are so many postal schemes today having a multiple number of years. Then the floater funds talks about one of the open-ended debt scheme, investing in the floating rate instruments, fixed rate instruments, sometimes convert to floating rates exposure, like swaps and derivative, hybrid, conservative hybrid fund, balanced hybrid fund, or aggressive equity saving. There also I said example, index fund, which is tracking the specific index, right? And funds over domestic funds. All these are covered on the this class. So we'll see remaining in the next class. Thank you.